Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about annuities, and the reason I'm bringing this up is because I get a lot of requests on, Adam, does an annuity make sense anymore? I know my parents or my grandparents did it back in the 70s, 80s, 90s. Interest rates were sky high at that point. So does it make sense in today's low interest rate world? So what is an annuity? Annuity is essentially where you put money into an insurance company. Think of it like a savings account, a guaranteed savings account with an insurance company where they guarantee you a set amount of payments for your lifetime. Part of that payment back is going to be some interest, some of it's your principal or your capital, and some of it is a calculation of other people that bought annuities that died early, so it's some of their returns. So that's kind of built into it as well. So there's three pieces to payments that come back to you. When you set up an annuity, you can collect payments on a monthly, quarterly, semi-annually, or annual basis. Okay, so it depends on how you like cash flow. For most people, it's probably going to be on a monthly basis, especially if you're entering into retirement and you're buying the annuity for that income stream. There's some people that buy annuities for a big set expense. We have some clients that buy an annuity for paying life insurance proceeds for future death. So that will be a one-time payment. So they might set it up annually. So it is flexible on when you can start your payments as well. When you go to purchase an annuity, there are many options and many factors that kind of tie into how much you're going to get paid. So obviously your age, your gender is going to play into it, how long you want this to pay for. So if I buy an annuity, and I'll go through this in a little bit here on the illustration, but I want at least a 10-year or a 15-year guarantee payment. So if I pass away in the first 10 years, it will still pay out to my beneficiary for the remainder of that 10 years. The longer you extend that, the lower your payment is because they're guaranteeing a payment for a longer period of time. Now keep in mind that an annuity is purchased through either a life insurance advisor or an annuity advisor, which there's not a lot of those out there anymore. So myself, I am licensed in BC as an insurance advisor. We have put a couple policies in place over the years for annuities. If you're looking to get an annuity in place, talk to an insurance broker, and what they'll do is they'll go on a program called Canex, and then it spits out, here's the different options for all the companies that are on the marketplace. So you're getting kind of the best of the best, not just a quote from one individual insurance company. When looking at and comparing different types of annuities, there's three main types of annuities. So the first type is a life annuity, and this is basically will pay you for your lifetime. So as long as you're alive, it will pay you a set monthly amount. What are the pros of a life annuity? There is no risk of outliving the money. If you put that money in with the insurance company, it guarantees you, even if it technically runs out of money, it never runs out of money. And this is why annuities kind of catch eyes of retirees, especially those of you that don't have a defined benefit pension plan. You can also have on these annuities a beneficiary. So, again, if you have a joint, you can have a continuation payment. So you could set it up husband and wife so that if the wife passes away, the husband keeps getting it at 100%, 70%, 60%. You can set it up however you want, and vice versa. So much like a defined benefit plan. Now, the downsides of a life annuity is you may not outlive your money. There is a chance that if you pass away early and you don't have a long guaranteed payment term on there, it could actually mean that you don't get all your money back. If you give them $100,000 and have a 5-year guarantee and pass away in year 5, and you've only collected, say, $40,000 of your $100,000, the other $60,000 is absolutely gone and lost. So if you add on the spouse or partner or someone joint on there, obviously that's going to drop payments a little bit. So as you add more benefits, inflation protection, length of guaranteed payment, as you add these things on, your payment continues to drop and drop and drop. So keep that in mind. That is a downside, is you may actually not get all your money back out of the annuity. So the second type of annuity is a term certain annuity. And what this is it guarantees your payment for a set period of time. Okay, so let's say you give money to an insurance company, you buy an annuity, and they guarantee you $1,000 for 20 years. If you live beyond 20 years, the payment stops at 20 years. Okay, a term certain annuity pays for a set period of time, whether it's to you or if you pass away to a beneficiary, whoever it is that you've kind of left as to collect that money on. What happens if you have a, say, 20-year term certain and you live beyond 20 years? That payment stops, it's no longer there for you, and you've essentially outlived your money. And that could be a concern unless it's built into your financial plan. The third type of annuity is a variable annuity. And this is, you're buying an annuity with a very small guarantee on there, but there's market upside. So what happens is a small part of your payment is guaranteed, and the remainder of it is variable depending on investments and how they do and whatever. And again, every insurance company will structure these a little bit different. This may not be a great option for you in retirement because, again, most people that are buying an annuity, they want that control, that guarantee. So I would look at a life annuity or a term certain annuity for yourself. So now let's look at when to buy an annuity. And a lot of people, again, they buy annuities for a certain reason. Maybe it's to pay for an insurance policy. We've had a couple annuities fall on our R plate that are part of an estate. So parent passes away, they maybe have a child or children that they don't fully trust, and thus they write in their will that any proceeds, disposition from the estate that go to my kids have to be put in an annuity. For a lot of you that are watching this video, you're thinking about, or maybe you're now thinking about, does an annuity make sense for me when I hit retirement? I don't have a defined benefit plan. I have a lot of savings and other stuff, but it'd be nice to have that guaranteed income beyond CPP and OAS. Now you can buy annuity with a lump sum payment or with ongoing payments over a set period of time. But typically, you're gonna buy an annuity with a lump sum payment. Most insurance companies do require a minimum of $50,000. Now, if you're looking to add an annuity to your overall retirement income stream, you have to look at your other income sources. Annuities are not something where you want to put all your money into it. If you're buying an annuity, it needs to be a piece of the pie. Your OAS is a piece, CPP, your annuity, and then everything else you have comes together. And again, you need to look at your income streams, not as silos, but as a comprehensive plan. You have your RSP and your TFSA and your CPP and your OAS and your pension, whatever else, and now you have your annuity maybe. This all needs to come together on a clear income and tax plan. If you don't have something that comes all together, you're gonna pay way too much tax and you're not maximizing your income stream. Don't just buy an annuity because you want income stream for life. Does it give you enough income? Does it provide income for long enough? There's a lot of factors that come into income stream in retirement. So let's take a quick look at the Annex program, and that's what we're looking at here. So as you can see, we choose your province, client name, birth date, gender, so annuity type. So here's your single life, your joint life, or term certain. So these are the three options we have in here. So again, if I go single life, is it gonna be an RSP, locked in RSP, a non-registered? Now the difference between non-registered, prescribed, and non-prescribed. Prescribed non-registered annuities, basically they take the tax bill over a period of time and level it out. Whereas a non-prescribed is, because there's kind of more money in the pool earlier, you're gonna pay more tax. More of the income is gonna come to you on a tax basis than later on in the payment schedule. So typically I would recommend, if you're doing a non-registered annuity, to do a prescribed annuity. So again, you can choose your type, RSP, and then guaranteed payment or cash refund. So if we go a guaranteed payment of 10 years on here, $250,000 deposit, and let's say that's going in today. And we can see this is a 60-year-old male in Ontario. We have a 10-year guarantee on there. It's an RSP money. And this is going to give this individual a lifetime payment of $1,175 per month as long as he lives. And again, there's a 10-year guarantee. So if he passed away anytime before year 10, this would continue to pay to his beneficiary. If we look at that number, $1,175 a month, so that payment will actually decrease over time when you look at it in comparable to inflation. Within the software, you can add inflation on here, and typically we would. So you can see down here, annual income index. So if we go 2% index inflation, we'll see that payment will go from $1,175 down to $923. Okay, well, what happens if we want 2% and we want, say, a 20-year guarantee? You're gonna see it goes from $923 down to $883. So again, the more features and benefits we add on to these annuities or policies, the lower your payment goes. And that's why you need to sit down with your agent or your broker and find that sweet spot that makes the most sense for you. Break down the rate of return. For this one at 0% inflation, it was about 3.87 to age 90. If they live till age 85, it's 2.91%, and live till age 80, it's about 1.22%. The second policy I want to look at here is a non-registered prescribed annuity, and this is a 60-year-old couple out of Ontario again here, and we've done a guaranteed payment for 10 years. So it's a joint life annuity, reducing on first death, and you can see here I've added 75% continuation, which means that if either one passed away, 75% of the payment will continue for their lifetime, right? It's a joint life annuity. It's not a term certain, it's a joint life annuity. It pays for lifetime. Again, I've indexed this at 0% for now for simplicity. You'll see that the payment comes out to $1,065 per month. And you can see here the different insurance companies that are offering. And this is why I say it's very important to get this breakdown from your advisor. So Desjardins Financial is giving us $1,065. Canada Life's the next one at $1,039, Sun Life, BMO, Empire, Equitable. Each company has different kind of benefits and features within the policy. So it's not just necessarily take the highest payment. You have to talk to your broker to figure out what the difference is between those payments and between the companies. The rate of return on here, if the couple lives, if there's payment to age 90, so 30 years to payment, it's about 3.08%. Age 85 is 2.04. And the break even to get your money back on this policy is age 80. So as long as one of the two spouses live till age 80, it would break even. Now again, if one of them passed away really early and it dropped to 75% payment, the break even would actually extend a bit further, obviously. Most people buy an annuity not for a great rate of return because it's not there. They buy it for guaranteed income, and if you're looking to buy an annuity, that's why you should be buying it. Now again, the rate of return and the amount of income they're giving you is based on current interest rates. So as interest rates go up, maybe annuities start to make more sense going forward. But in my opinion, to get a guaranteed 2% rate of return, I would rather get a little bit less, put my money into high interest savings account at like EQ Bank or something like that. Again, I'm not getting as great a return maybe now up front, but as interest rates go up, I think I can average out a bit better than that over 20 years, even in a savings account maybe. So look at what's out there. Don't lock your money up because it's safe when you're not getting a great rate of return. If you're gonna put $500,000, let's say, into an annuity, which is half your assets, and it's guaranteed you an income, and it meets your needs, and it really checks the boxes and allows you to sleep at night, maybe an annuity is for you. Everyone's situation is different. From a numbers wise, like rate of return, I don't see it as a great investment. Now, the last thing I want to point out here is, are your annuities protected? So what happens if the insurance company goes bankrupt or something happens with your annuity? Well, every single annuity in Canada is protected through Assuris protection. This is a government regulated insurance. So it's kind of like CDIC for your bank account, but it's Assuris. And you can see here that if your payments are under $2,000 on a monthly basis, then you're protected 100%. Anything over $2,000 is protected at 85%. Make sure that you buy it through a fairly large company that you've heard of. You understand that it is protected through Assuris. That is important, but just be aware that any amounts up to $2,000 are 100% protected. If your payment is over $2,000 a month, the whole amount is protected at 85%. So thanks so much for joining us in this video. Hopefully you have a better understanding of annuities, what they are, how they might work in your plan. Do they make sense for you? Again, I don't think they make sense for 99.9% of you, but there's definitely a small sliver of you watching this video that it might make sense for you. Again, if you run the numbers and the income it generates is all you need and it's guaranteed and it allows you to sleep at night, that's a good solution. So that may be where it fits for you. Again, for most of you, to guarantee that 2-3% rate of return doesn't make a whole lot of sense. There's better options out there, especially right now. So again, hopefully this helped you out in annuities. Thanks so much for joining us in this video today. We'll see you in the next one.